Here we go, folks. Dave from Macro Shock, ready to break down the latest seismic shift in the global economy. Are we on the brink of a full-blown, no-holds-barred trade war that could unravel months of market gains and send us spiraling into uncertainty? Because what just happened with China and those new tariff threats could be exactly that, and it demands our immediate attention. Folks, the news broke on Friday, October 10th, 2025, and it sent shockwaves across global markets. President Donald Trump, in a series of posts on Truth Social, announced a massive escalation of trade tensions with China. He declared that the United States would impose an additional 100% tariff on goods from China on top of the existing 30% tariffs effective November 1st or even sooner. That means we're looking at potential tariffs of up to 100% on Chinese imports. But that's not all. Trump also stated that the U.S. would implement export controls on any and all critical software, also starting November 1st. This aggressive move comes in direct retaliation for China's recent decision to ramp up export controls on critical rare earth minerals, which are essential for manufacturing everything from electronics and electric vehicles to military hardware and AI chips. China's new regulations require foreign entities to obtain licenses to export products containing even tiny amounts of rare earth elements, and they've even expanded controls to include their production technologies. The mainstream media, from CNN to CNBC, is reporting this as a significant re-escalation of the trade war, shattering a months-long calm on Wall Street. Markets reacted swiftly and negatively on Friday, with the Dow falling by 878 points, or 1.9%, the S&P 500 dropping 2.7%, and the tech-heavy Nasdaq tumbling a painful 3.5%. Investors are clearly rattled by the uncertainty and the potential consequences. Economic disruption this could cause. Trump even hinted at canceling a scheduled meeting with Chinese President Xi Jinping in South Korea, further fueling fears of a deepening rift between the world's two largest economies. This isn't just a political spat, it's a potential earthquake for your portfolio. Let's break down the possible scenarios and their market impact. Scenario 1. Full-blown trade war, 50% probability. In this scenario, Trump follows through on his threats, and China retaliates with its own aggressive countermeasures. We see the 130% tariffs implemented, along with stringent export controls on critical software. Expect significant downside. The S&P 500 and Nasdaq could easily see another 10–15% correction, possibly more, as global supply chains are severely disrupted and corporate earnings forecasts are slashed. Investor confidence would plummet, leading to a flight to safety. Specific market sectors. Technology, heavily negative impact. This sector is on the front lines. Companies like Apple, AAPL, heavily reliant on Chinese manufacturing and consumer markets, would face massive cost increases and demand destruction. Semiconductor giants like Nvidia, NVDA, and Qualcomm would be hit hard by both the tariffs and the critical software export controls, impacting their ability to sell chips and software components into China, which is a huge market. We've already seen Nvidia and AMD drop 2% and 6% respectively on Friday's news. Consumer discretionary, negative impact. Increased prices due to tariffs on imported goods would squeeze consumer spending. Retailers like Walmart and brands like Nike, which have significant manufacturing in China, would see higher costs, lower margins, and potentially reduced sales volume. Industrials, negative impact. Companies with complex global supply chains, such as Boeing and Caterpillar, would face increased costs, delays, and potential loss of market access. Energy, negative impact. A global trade war would undoubtedly slow global economic growth, leading to reduced demand for oil. We already saw U.S. oil prices slump 4.5% and Brent crude drop 4.1% on the news. Major oil companies like ExxonMobil, XOM, and Chevron would likely see downward pressure on their stock prices. Financials, moderate negative impact. Reduced global trade and economic uncertainty would impact banking revenues, investment activity, and increase credit risks. Major banks like JP Morgan Chase and Bank of America would feel the pinch. A few major well-known stocks: Apple, Nvidia, Caterpillar, ExxonMobil. Scenario 2. Negotiations and partial tariffs, 35% probability. In this scenario, the initial shock leads to renewed negotiations and a more moderate outcome emerges. Some tariffs are implemented, but not to the full 130%, and export controls are either softened or strategically applied. A period of high volatility, but with potential for a recovery rally as uncertainty decreases. We might see the S&P 500 and Nasdaq trading sideways to slightly up after the initial dip, as investors price in a less extreme outcome. Specific market sectors. Technology, mixed impact. Companies less reliant on China or with diversified supply chains might recover faster. Those deeply embedded in the Chinese market would still face headwinds but could adapt. Microsoft, with its broader software and cloud focus, might be more resilient than a hardware-heavy player. Consumer discretionary, moderate negative impact. Tariffs would still impact costs, but potentially to a lesser degree, allowing for some price absorption or supply chain adjustments. Industrials, moderate negative impact. Similar to consumer discretionary, supply chain adjustments would be key, and the impact would be less severe than a full-blown trade war. Energy, moderate negative impact. Global growth fears would still exist, but a less severe trade war could limit the downside for oil demand. Financials, neutral to moderate negative. Less economic disruption would mean less impact on financial institutions. A few major well-known stocks: Tesla, TSLA due to China production sales, Intel, Walmart. Scenario 3. De-escalation, 15% probability. This is the most optimistic scenario, where the tariff threats prove to be a negotiating tactic, and both sides step back, perhaps agreeing to a new trade truce or a significant de-escalation of tensions. A strong relief rally, potentially pushing the S&P 500 and Nasdaq back toward recent highs, as a major overhang is removed. Specific market sectors: almost all sectors would benefit. Technology, strong positive impact. The biggest beneficiaries as trade flows normalize and fears of export controls dissipate. Companies like Apple, AAPL, Nvidia, NVDA, and TSMC, TSM would see significant rebounds. Consumer discretionary and industrials, positive impact. Lower costs, stable supply chains, and renewed consumer confidence would boost these sectors. Energy, positive impact. Improved global growth prospects would support oil demand and prices. A few major well-known stocks: Apple, Nvidia, Amazon, AMZN. All right, so what am I doing with all this? Personally, I'm not hitting the panic button just yet, but I'm definitely in defense-first mode. I'm taking a cautious stance, watching from the sidelines and protecting my capital. I believe the market is still processing the full implications of these threats, and until we get more clarity, capital preservation is key. This isn't the time to be a hero, it's the time to be smart. Now, let's talk about the SPY, because the charts are telling us a critical story. Despite the recent pullback, the SPY is still technically in an uptrend. However, it's currently resting on a crucial support level at 650. This 650 level is absolutely vital. If this support breaks, the next levels we're watching closely are 633 and then 614. A breach of 650 would signal a significant weakening of the current trend. To resume its uptrend and show us some strength, the SPY must maintain above 672. That 672 level is our bullish confirmation point. Until we see a sustained move above that, the bears have the momentum, and the risk remains to the downside, especially with this tariff cloud hanging over us. I'm keeping a very close eye on these levels as the market digests this latest macro shock. What do you think? Is this the start of a new painful trade war or just another negotiating tactic? Let me know your thoughts and your market strategy in the comments below. And if you're getting value from this analysis, smash that like button and hit subscribe so you don't miss our next macro shock breakdown. Remember, this is not financial advice, just my analysis and personal take. Always do your own thorough research and consult with a qualified financial advisor before making any investment decisions. Your capital is at risk.